Ladies and gentlemen, good afternoon, and thank you for all to following me to speak with you today. The topic I wanted to explore you is the one that is official to building a long-term wealth and financial independence, investing. And whether you are associated investor or someone who is beginning to dip their toes into the world of finance, understanding how investments work and, more importantly, how to make them work in the essential today fast-paced fast-paced economy. So now, let's begin with the fundamental question. What does it mean to invest? And it's the simplest thing. Investing is to active putting money into the financial assets like stocks, bonds, or real estate with the hope of generating returns in the form of income or profit. But if we look deeper, investing is more than it. It's about planning for the future. It's about securing financial freedom, not just about ourselves, but potentially for our families and future generations. And it's about making strategic decisions today will pay off tomorrow, next year, and perhaps even decades down to the line. But why should we invest in the first place? Isn't saving money a bank account enough? The short answer is no savings. While crucial for short-term needs and emergency, are not enough to build wealth in the short term. Why? Investing in inflation. Inflation is a slow but steady force that erodes the purchasing power of our money over time. To put simply, the $100 you have today will put less in 20 years than it does now. The, in fact, even modest inflation is say 2%. A year can cut the value of your savings in a lower 35-year period. So, if you're replying to savings alone, the money is just sitting idle. It's activated loss value. Where investing allows the money to grow. They outplace inflation and to grow over you rather than against you. Let's break this down with an example. Suppose you have $10,000 and you were deciding whether to save it in a regular savings account or invest in stock. And if you choose to save it and in a bank offers an interest rate of 0.5% per year, after 10 years, your $10,000 will grow of over $10,050 barely keeping pace with inflation. With all, however, if you invest than $10,000 in a rogue market stock index that averages an annual return of 7%, in the same 10-year period, your money should grow in a nearly $20,000. Over 30 years, the investment could grow over $76,000, and that's power of compound interest, a concept Albert Einstein reportedly called eighth wonder of the world. So, that's at least a compound interest, and why it should be so powerful. Compound interest is the process in which your investment grows and it just balances on the initial amount you invest, but also your return that the investment generates. Essentially, you start earning interest in your interest. No longer just let your money compound. The more exponentially it grows, is the starting early crucial in the world of investing. Time is not valuable as in the asset that you have when it comes the growing you health. First, we have stocks. Stocks represent ownership in a company, and when you buy a stock, you're essentially buying a small piece of that company. Over time, the value of stock can increase in the company grows, and you may also receive dividends, which are payments that some companies make to stakeholders from the profits. Stocks are often seen as a high risk, high reward type or investment. Historically, stocks have delivered higher returns than more asset classes, but they also come with more volatility, meaning that the prices can fluctuate initially over short periods. Bonds are generally considered lower risk investments than stocks, but the returns are usually lower as well. However, they can provide a steady source of income and stability to a portfolio, especially at times that market uncertainty. Also, another impacting element of investing is having clear, realistic, and financial goals. Are you investing for retirement? Are you saving a down payment on a home? To fund your children's education? Setting specific goals may help you to define your investment strategy, allows you to measure your progress over time, and it also keeps you disciplined and focused especially during volatile periods.